you all very much indeed for joining us today. We are absolutely delighted with the attendance, both in size and also in geographical diversity. And I'm particularly pleased that there are a lot of people following us today in the US. I'm going to take you through just the headline findings of a research study that IFI Global's research department has been conducting for just over 4 months now on fund domiciliation. The full report will be published at the end of the month. So today, what I'm going to do is just pick out what I think are the most relevant findings, particularly for a US audience. And then we are going to get into a panel debate focusing on issues that arise out of the research and no doubt a number of other topics too. You are all very welcome and indeed encouraged to join in. If you'd like to do that, please just go to the Q&A button at the bottom of the screen. I will try to take questions to a certain extent as we go along, but we will also allow, probably roughly speaking, around 10 minutes at the end for other questions too. Now, on the panel today, we have Stephen Culhane, who's a partner at Arnold and Porter, Miles Edwards, who's General Counsel and Chief Compliance Officer at Bruderman Brothers, Eileen Overbauer, who's partner at Lowenstein at Sandler. Those three are in New York, or if not in the city, then in upstate. And we have Elliot Revson, who's head of funds at Jersey Finance as well. And for those of you that don't know me, and I think today there are quite a lot of people in that category, my name is Simon Osborne. I'm the CEO of IFI Global, which is a research and media firm based in the City of London. We have 3 monthly publications focusing on fund governance, ESG's impact on the fund industry, and how Brexit and regulatory changes are altering the European fund business. I would particularly like to thank Jersey Finance for sponsoring this event today. We very much hope to be back in New York doing physical events with them again later this year. Right, now I'm going to quickly take you through some of the research findings, as I just mentioned. This is the breakdown of the interview set by category. The term advisor we use for particularly lawyers. There's a lot of lawyers in that group, but also the KPMGs and the PwCs and entities like that as well. And this is the geographical breakdown. As you can see, the vast majority of the interviews have been done in the US and in the UK, but we have included some people in Australia and Canada too. The managers survey, incidentally, have a combined alternative asset total of approximately $90 billion. And they work for firms that overall, in everything they do, have assets of about $2.1 trillion. And I'm very pleased that we have investors, or at least those advising investors, from these 4 countries that are on the screen now. So, as I say, these are the main findings I picked out that I think of particular relevance to the US audience. The main study will have other ones, obviously, too. And perhaps the most important point to make is the very top one. And we did a very similar study to the one we've just come to the end of now a year ago, also with Jersey Finance. And this is really an update of what we did back then. What we found then, and indeed we found now, and I'm sure if we did it again next year, we'd find next year as well, is that what investors want is they want to allocate to funds in well-known jurisdictions with a good reputation, solid infrastructure, and considerable expertise. Managers following this should really obviously bear that in mind. I'm sure they doubtless know that anyway. One of the things that the study has found this year is that there are differences in what UK and US managers would consider their highest priorities when it comes to fund domiciliation. I'm not going to get into what the highest priorities of the UK managers are now. Of course, that will be in the final report, but we will talk about what are the priorities for the US managers. What US managers seem to want overwhelmingly is a fund jurisdiction which gives them the least cost and basically the least hassle, which then brings us on to the penultimate bullet point on this slide, which is as more substance and regulatory requirements are imposed upon what have traditionally been low-cost jurisdictions, some managers and their advisors that we picked up on in this research are now, probably for the first time, we haven't found this before really, are beginning to look around for alternatives. I'm not going to exaggerate that and say everybody is, but we did pick up on some that are, and we will be coming back to that topic when we get into the panel discussion in a few minutes' time. Finally, there's a big part of the study which was on COVID-19, which is now very dated because we even designed the questionnaire before that we had the vaccine rollout. Thank God we have the vaccine rollout, but we were worried that we'd be going into this year with no solution to this pandemic crisis. Hopefully that has changed everything, i.e. the vaccine rollout. But one thing I can say perhaps that is relevant is that if the pandemic does go on for a long time, the most likely way, according to the research response we received, particularly from this side of the Atlantic, is going to be on the EU industry's peripatetic structure. And the EU fund industry is extremely peripatetic. Don't tell the green lobby how much air travel is relied upon to keep the European fund industry going. And it must have a massive carbon footprint, at least outside when there's a pandemic going on. Now, one of the places where we have the biggest differences probably in response, and one of the few places probably where there are differences in response from the different sides of the Atlantic, is in the response to the questions we put in on ESG. This is the first time we've done research which has covered ESG from a fund domiciliation point of view. As we put on the top of the screen here, all investors we interviewed and their advisors think that ESG will play a more important role in everything, including in fund domiciliation. A better way around of putting this, it's not that they specifically think it's something that is relevant to, this is domiciliation, that is relevant to ESG. They think ESG will change a lot of fund industry business practices across the board, and that therefore includes domiciliation and service provider selection too. They're just not making exceptions for that. They would say it doubtless would be in many other areas as well. And just over 2/3 of the overall sample think ESG criteria will play a growing role. So not everybody, but the majority. But there's quite an important and significant subset within that, which is just the subset of managers and advisors. So we've taken the investors out of the response to the third bullet point here, which is that there we have it, 39% of managers and advisors do not think ESG will become more important. Those people who said that are almost all of them. I think there was at least one exception in the UK, but the overwhelming majority of the people that said that are in the US. They see ESG as more of an overlay strategy. Other than that, they don't see it as being significantly different from anything else. Again, we may get into discussing that in a few minutes when we get into the panel. One possible reason for that is that in my lifetime, virtually every investment strategy that I've come across has been invented in the US and then was exported to the rest of the world. ESG may be the first time something was created somewhere else and is now being imported into the US, and maybe in some respect it is somewhat behind the rest of the world in terms of its development, although I think that's changing incredibly quickly. And with the new president in the White House, we know that there's a lot of stuff that's happening in terms of his Green New Deal and so on and so forth, which I'm sure will spur it on a lot further. Finally, this is probably less relevant to a US audience, but I think it's still somewhat relevant, which is why I put this on the screen. Over here in Europe, we have the many joys of ESG regulation coming down upon us. I don't think that's the same in the US yet, but it probably will be in the near future. Today, I think, is the 10th of February. In exactly a month, the EU starts the rollout of this incredibly contentious, highly complex ESG regulation called the SFDR, which they have put a lot of effort into developing. That starts, as I say, exactly in a month's time. The rollout goes on from then until probably until early next year in various different stages. They were hoping to export that to the rest of the world. There was an intention to try and make that more of a global standard of ESG regulation. I think that's incredibly unlikely to happen, but that's just my opinion. The UK has already said it's going to diverge from it. We're going to have what's called the TCFD, which is much less onerous for managers, and it's coming in later anyway. I don't think the US would be going down the route of adopting anything along the lines of the SFDR either. And so we have the UK already diverging, and the US, I would very much expect, will do its own thing if and when it gets to it. Brexit, we talk endlessly about Brexit, and we just did an event on that the other day. I could keep you here till midnight US time talking about Brexit. I'm just going to make a few quick points of relevance perhaps to a US audience on this. The first point being managers, and particularly including, of course, many US managers with their European headquarters in London, have made their post-Brexit plans an awful long time ago if they have substantial investor bases in the EU. Predominantly, that's either Luxembourg or Dublin. They've got operations in now, but it could be other places too. However, many of the boutique managers that we interviewed in London have not made plans because, frankly, the EU isn't really much of a priority for them. If they think Europe, the market that's by far the most important for them is Switzerland, which is not even in the European Union anyway. But for a lot of these boutique managers, the US, the Gulf, the Asia Pacific region, etc., are for them better alternatives alongside, of course, Switzerland. So they haven't made plans, but they are watching what's going on. There is, at the moment anyway, the opportunity of reverse solicitation, which is used, I know, by many American managers, and private placement as well. That could be changing, but I doubt we'll get into that today, but possibly we could. Interviewees we have come across are on the whole very pessimistic about the UK reaching an equivalence agreement with the EU, which on one level is really astonishing because don't forget the EU or the UK was part of the EU for what's now known as the EU since the 1970s, an awful long time. So at the moment, we have pretty much exactly the same aligned regulatory regimes in financial services. But the EU has said, no, it's not going to give us equivalence, at least in the short term. I think in the US, you do have equivalence with the EU, but we're not going to get it. And that's primarily because the UK has made clear that it is going to be diverging in financial services regulation. So as a result of that, they don't want to grant us equivalence for the time being. Finally, this is a very contentious point at the bottom of the screen, but probably not that relevant necessarily to a lot of people in the US, which is it's likely we're going to see changes made to distribution and portfolio management delegation rules. When I say it's not that relevant to the US, it's because if that does happen, they're probably going to keep the delegation rules that you have in place forever, certainly for the time being, meaning that if you're a US fund, you can delegate your portfolio management to a team in New York, Boston, Chicago, San Francisco, wherever it may be, because that makes sense because you're in the market making where the investment decisions are made. Ditto a Japanese fund, ditto a Southeast Asian fund for Hong Kong and Singapore. But for European funds, the EU is saying, we don't see why that should be in London. They want a piece of the action. It's about 1.9 trillion euros, so well over $2 trillion worth of money that's run through London for European investors. And the EU is making, or we're told the EU is making consideration to try and change the rules on that to have it be run from Paris or Frankfurt or wherever it may be. Finally, before we get into panel discussion, quickly, what's coming up on the research front from IFI Global? As I think I've already mentioned, the full results of the study, which I've just quoted from, will be published at the end of this month, and we'd be delighted to send those results to all of you. So we'll be back in touch with you about that in a few weeks' time. Once that's out of the way in March, we are doing a study, which first time we've done something like this, and we're really looking forward to it, with US managers and advisors on fund director selection. Anyone who wants to be interviewed for that, who's in the manager or advisor category, please let me know. And then in April, we do the same thing for the UK market. So that is enough from me in terms of the introduction. I'm now going to stop sharing screen and bring the panel up. Great, there they are, Stephen, Miles, Eileen, and Elliot. So we'll go through a number of the points, and hopefully we'll go off in the byways and highways and byways over the next 45 minutes and just see what takes us. And I see there's already questions coming in. Perhaps we can go first, since it's a big chunk of the research that we've done this year, to the ESG stuff. And perhaps first to you, Miles. Do you think that ESG will have an impact on fund domiciliation? And if so, how will that happen, if that will happen at all? As I say, there was a number of dissenting voices in the US on that particular topic.
Yeah, I agree it will, because alternative managers traditionally have always sought out sort of what we call these lessly regulated jurisdictions. And now what we're finding is that ESG is tracking it. And you made a very good point about the UE Sustainable Finance Disclosure Regulation, which is going to become effective on March 10th. And what's a little bit troubling about that is that it places increased burdens upon managers. And basically what it says is three things. We have to disclose how sustainability risks are incorporated into our decision-making. We have to disclose any principal adverse impact of investments made on external sustainability factors. And we also have to disclose how we make decisions regarding products. So it goes down to even product level decisions. And for us, that kind of puts us at a place where if we are going to look at the European Union or anywhere in Europe to domicile these funds, then we have to take that into consideration. Whereas with Cayman, for example, they've been very slow to react. I mean, you have the Cayman Islands private fund law of 2020, which only really addresses corporate governance. It doesn't really go into any other disclosure items that would impact upon ESG. So we're really, Simon, at a balancing act now, where we have to balance between making sure our funds are ESG compliant and not be accused of what they call greenwashing, which is saying we have an ESG fund, which really isn't one, and also making sure that we're in a jurisdiction in which we can efficiently and economically operate. And one of the reasons we like Jersey so much is that, you know, it's embraced ESG in a really rational and flexible manner. And also Jersey funds, other than these notification only funds, are eligible to be marketed into the European Union. And so therefore, we need to continue to look at ESG as one of the factors to determine where these funds are going to be domiciled.
Thank you. And Elliot, can I come to you? Do you think that ESG will impact fund domiciliation? And if so, how do you think it will impact fund domiciliation?
Hi, Simon. Well, certainly the topic of ESG it's been growing in prominence for a while. It's accelerated to the fore during the COVID pandemic. And one point that your survey highlighted is that it's clearly front and center in the minds of investors and accordingly managers, but that it has not yet filtered through to the jurisdictional level. I believe based on that, as we've seen in other areas, there is an opportunity for a single jurisdiction to take the forefront and to lead in the ESG business. But I don't think there's a single, I don't think there's a silver bullet. I think that it will be a combination of stratagem. In Jersey, we have a very joined up approach with our government, regulator and industry working together to innovate. And we are now seeing this in the ESG space. Our government has a vision which they are carrying out. Our regulator has just completed an industry consultation as to what makes sense. And we as an organisation, Jersey Finance, have just completed a very large piece of work with an organisation called Equilibrium Futures. And I think that these three areas will shape our credibility in the space. But I think it's more than that. And I think there needs to be a trigger to start the conversation. And that our funds industry needs to lead from the front. And to Miles's point, this has to be credible and not greenwashing. We recently launched what we've called the Jersey for a Wilder World scheme. And that was designed with exactly this point in mind. The scheme is a joint project between industry, ourselves at Jersey Finance, our government, Jersey Overseas Aid, and the Durrell Wildlife Conservation Trust. And it's aimed at sending a very clear message that Jersey and its service providers are committed to the ESG agenda and to supporting global investment aimed at driving positive change at a time when there is clearly renewed vigour and accelerated progress in all areas of sustainable finance. The scheme is very simple. The service providers, the administrators, lawyers, accountants and auditors can donate a minimum of a percentage of their fees when earned when working with sustainable funds. Durrell pools the donation and assigns them across their established rewilding programs, and Durrell are the proven market leaders in making a positive impact in the sphere of social change. In return, those firms get a kite mark and a certificate and an annual update from Durrell on the projects they've supported. And this then allows them to demonstrate their credentials in the growing ESG market and to be able to start the conversation.
Okay. I'd like to spend a couple of minutes on ESG because there's some other things I want to ask, but somebody has asked a question. Let me read it out. Anyone who wants to, please pick it up. Is it clear that, is it clear that it is the management company and not the portfolio management that has the ESG responsibility in the EU? Does anyone know the answer to that question? Because I haven't a clue. That would be in the SFDR regulation. Is it the management company or the portfolio manager? Or is it both that the SFDR is going to be covering? Is that an area you know something about, Miles, or not? No? Okay.
I'd say simply that the portfolio manager is a representative of the management company. That's the only point I'd make.
Yeah. Can I ask, whilst we're on the subject of the regulation of ESG, what is the, if anything at all, in the US? And do you expect there to be more regulation in this area in the foreseeable future or not? And if so, what sort of thing? Will it be more like anything like the European Union's SFDR, or do you think it will go down another route, or are we years away from that ever happening at all? Has anyone got any thoughts on that?
I'm happy to hazard that in the private fund space, it will be it will remain a deregulated market, and that developments will be driven largely by the larger investors in the space. Right.
And how about in the public markets, the 40 Act funds? Is what will happen there? Do you think there'll be more regulation?
I personally don't work with the registered funds enough to speak to that.
Right. Okay, well, let's move on to the thorny issue of substance. Stephen, perhaps I can first come to you. Do you think that the growing substance demands on international fund jurisdictions, which is happening to all international fund jurisdictions, by the way, it's happening in the EU as well as offshore, but I think we're probably talking more offshore than in the EU right now when I ask this question. Will the growing substance demands on international fund jurisdictions have an impact on fund domiciliation patterns?
I think that they have, and they will. This is clearly a trend that is going to continue, and it is shaping determinations as to where to put funds. I think the analysis is very much what you've outlined in terms of sort of baseline requirements. You need a jurisdiction with good infrastructure. It needs to have a decent reputation. The infrastructure needs to include the expertise to comply and address with the local requirements and to be responsive to international requirements, whether those are US or other jurisdictions. After you've sort of satisfied those baseline requirements, I think there are a series of issues that one then turns to, and these analyses are always driven by what is the fund investing in and who are the investors in that fund. One of the questions that's come up in the Q&A is the impact of taxes. Taxes is clearly one of the things that drives the domiciliation of funds, and depending upon what the underlying assets are, it may have a very significant impact on the structure of the fund itself. So one of the things I was working on earlier today is a real estate fund that invests in US real estate on behalf of a non-US manager, non-US investors. You end up with or you certainly can end up with a very complex structure that's intended to address, in that instance, primarily US tax issues. The impact of the substance rules clearly plays into sort of those issues, and also plays into the least cost, least hassle analysis that Simon, you identified earlier. And that least cost, least hassle tends to be driven by several factors. One is, where is the manager's existing infrastructure? If a manager has funds in essentially a particular set of jurisdictions, it is likely to be easier and cheaper to continue to do business in those jurisdictions. If you've already got infrastructure in Luxembourg or Jersey or Cayman, that will help steer the determination as to where to put a new fund. In the absence of essentially the inertia and the infrastructure sort of pushing you into a particular jurisdiction, you end up doing the tax and regulatory analysis. What makes sense for this set of investors? What makes sense for this investment program? And indeed, what's going to be easiest and least expensive? The increase in infrastructure requirements, the increase in tax disclosure and diligence is something that has affected the choice of jurisdictions. If you look at, just to pick on a jurisdiction which I work with closely and have for a very long time, if you look at a subscription book for a Delaware partnership and a Cayman partnership, for example, you end up with, at this point, several supplemental questionnaires and a great deal more disclosure that's required to address the non-US requirements. And interestingly, that has helped to push some funds back into the United States, funds that would have previously been organized outside the United States. Assuming that a manager doesn't already have the infrastructure in a particular jurisdiction, when you look at the cost and hassle analysis, there are jurisdictions that have requirements that are easier to satisfy than other jurisdictions. And as perhaps loyalty to particular jurisdictions weakens a bit, which I think has happened, there is a drive to assess additional alternatives. And I think that is something that we are seeing in at least some funds in the marketplace. And that's a trend, again, that will continue. I have, and I do want to respond also to the ESG space a little bit, which is to say that the ESG space is one that is sensitive to reputational issues and perceptions of particular jurisdictions. It tends to be a little bit more conservative, perhaps, than the alternative investment space more generally. And in my experience, that has meant that there is a higher degree of reluctance to invest in, or rather to invest in funds that are domiciled in jurisdictions that are perceived as being organized in tax haven jurisdictions. So that there is some resistance in the context of ESG funds to our traditional offshore jurisdictions. And that may push, again, depending upon the investor demand, that may push funds into back into the United States. If it's a US manager, it may push people into Luxembourg, may push people in both directions. I think a jurisdiction that to me has been an interesting one, both from a a cost and hassle perspective, as well as the perceptions of whether it is onshore or offshore, has been Canada, which has a regime that in some respects is similar to that of the United States. It's fairly hands-off if you have a limited regulatory nexus in the jurisdiction, and for the same reason that people like to go to Delaware, it's onshore, it's got a very established regulatory basis, a deep infrastructure, and is very much a known quantity. People are looking to see whether, where else they can go. And the substance rules have affected that. They've probably had a greater impact on non-US managers, since US managers, at least in the case of a registered investment advisor, even if you're a reporting advisor, you do get a bit of a pass. But they are clearly factors that are shaping the choice of jurisdictions. We're seeing jurisdictions being used with greater or lesser frequency now than we have in the past, in large part because of those substance requirements, and indeed the tax disclosure obligations. Not because I think people are evading taxes, but rather the burdens of compliance have increased.
Right. In the interest of having a good debate, I want to come to Eileen, but quickly, can I just make the point in passing, since you just referred to Luxembourg, and this is something that I think is worth making before the conversation goes off in different directions. Probably the jurisdiction, international fund jurisdiction, that's had the most grief over the last few years, not from the EU because it's in the EU, but from potentially from investors and from the tax justice network, which has driven some of this, is Luxembourg. There was a thing a few years ago called the LuxLeaks scandal, where some information was leaked out from into the press on various companies that were claimed in the tax justice network and were avoiding tax, and the Luxembourg authorities threatened to put some people into prison. And it's interesting, in particular the Australian superannuation funds and various other ESG orientated investors made it very clear to Luxembourg that would be a very bad idea indeed. It was 3 or 4 years ago now, so it may have gone into the past, but nothing like that has ever happened in any of the offshore jurisdictions. It did happen in Luxembourg. So it's not a simple, it's just offshore. It's any international jurisdiction that has a tax and tax neutral role. I just mentioned that in passing. Maybe we'll come back and have a bit of a debate about that later. But Eileen, can I bring you in to this discussion and also ask for your comments on what you feel about the growing substance demands on international fund jurisdictions everywhere?
Yeah, so I agree entirely with Stephen that tax is the principal driver of every choice with respect to jurisdiction and domicile, followed closely by regulatory cost and hassle. And I think it's a good thing when lawyers and accountants and other service providers look for creative solutions for their clients and for their managers to find places and options that might reduce that cost or those burdens. But that said, most managers in this industry don't want to be outliers, and they don't want to be out of step. Aside from their strategy, aside from how they create alpha, they very much want to look and feel like other managers of their ilk, of their vintage, of their geography. So where a particular jurisdiction or structure might look good on paper, a manager still might choose not to domicile their fund there because they really don't want to spend a lot of time describing their legal structure to their potential investors, or spending a lot of time in the room, so to speak, dealing with that rather than explaining why they are the best choice for managing your money.
Right.
I think that's a really important issue, and it is clearly one of the challenges that the quote non-traditional jurisdictions face. They may be completely straightforward as a practical matter, but the lack of familiarity with those jurisdictions may drive heightened diligence, additional questions, additional side letter provisions that are intended to address sort of the sometimes inchoate concerns that going into a new jurisdiction may present. I think it's very much it's an offsetting factor for the cost and hassle analysis.
I think, Simon, one thing that we've not touched on here is investor requirements and investors wanting, stable jurisdictions with a little change outlook. From a Jersey perspective, the rules that the laws that we put in place in respect of the substance requirements was in actual fact the codification of what was already best practice in Jersey, and we've subsequently been held up as a poster child for the economic substance rules by the EU. And one thing that we are very keen on doing is this triumvirate of our industry, government and regulator working together. And we are normally early adopters of new regulation, but in a very pragmatic way, in order to maintain our global reputation, which is backed up by the stability and longevity of our economy and our legal framework. And that lends itself very much to investor requirements, and they are key to this equation.
Do you think this is for everybody, do you think investor requirements are growing in this, or is it still the same? Do you think they're having more influence, particularly as ESG comes along, or for whatever other reason?
Yeah, I think there are some, but the challenge is that investors are unclear as to what ESG means to them. There's not really a standard as far as what investors are following. So unless they're clear as to what their mandate is, it's very difficult for managers to determine how we can go about and making sure that we're adhering to whatever standards they have. They simply say we would like to be ESG compliant, but that means a lot of different things to a lot of different people.
Right, that's a very fair point. I totally get that. Okay, we've got a huge amount more to cover, and I'm delighted. Thank you. I see questions are piling in. I can't keep tracking them all. What I think I'm going to try and do is perhaps go to questions a bit earlier. We'll keep going for the moment, and then we'll go to questions probably in about 7 or 8 minutes, and then we'll take it from there. Eileen, can I come to you on the question of European markets? I think I'm right in saying you work with a number of clients who have been accessing from the US European markets. In what ways do you think Brexit in any shape or form, if at all, might make a difference to that? And beyond Brexit, what are the views the American market has in terms of domiciling and accessing European markets?
Yeah, so by far the primary method of access for US managers remains reverse solicitation. And I really do think that will remain the case until something big changes, whether that's a high profile enforcement action of some sort by a regulator, or some change in the law that puts more guardrails on what it means to reverse solicit. So that's sort of the state of play now. As to the impact on Brexit, like most things Brexit, who knows, right? Who knows? And tomorrow the answer might be different, right? So to be determined, but I don't foresee any real mass marketing or huge inflows of managers trying to either domicile in the UK, put an office in the UK, or really market to UK investors. I think for now it's too much of an unknown, and until we know a bit more, it'll be a bit of a pause button.
Yeah, I don't suppose there are many managers, because everyone who's done what they've done, they would have done it a long time ago. But nonetheless, if you are a US manager, the obvious place to go and set up would be in London, and then that's your springboard for the rest of Europe. But that is probably, as you say, unlikely to be happening in the short term. So I don't know where else they would go to do that. Paris is nice in the spring, but it's a different culture, etc., and so on. I know there is an obvious alternative for them, because I'm not sure I did say this in my introduction. I do think someone said this to me last week. We're in a situation now where perhaps from 2016 to 2020 we had what somebody called the Brexit phony war. And now, from the beginning of January this year, we're into the real war. And the relations between the EU and the UK don't look like they're getting much better in the short term. We've had a problem with the vaccine rollout. That probably didn't get any coverage in the US. But certainly we're not, going to buddy up in a particular big way in the short term. So I don't know where that leaves US managers looking at the European scene. Does anyone want to comment on that before we go on to Oh, sorry, Elliot, I wanted to ask you as well about distribution into Europe and where you see it, what's going on.
I think the key point here is something that's been touched on. One of the first acts of the EU post-Brexit was to push back on reverse solicitation from the UK. And you and I have discussed this, Simon, albeit it was in the banking sector, but it would be a natural extension for this to be expanded to the fund sector. And it's inconceivable it could be limited to the UK. So US managers, as Arlene said, primarily rely on reverse solicitation to access Europe. If this goes away, then they're left having to comply with the AIFMD, which determines capital raising in Europe. The catch-all is that it is the AIFMD covers funds marketing in Europe or based in Europe, which means that if you have an onshore European fund and you market it to the rest of the world, you are on the hook for AIFMD. One of the key differentiations of Jersey, because we're outside the UK, outside the EU and independent in our own right, is that we have an opt-in, opt-out approach to AIFMD. So when you're dealing with the rest of the world, you're out of scope. And when you're dealing with Europe, you can access Europe via national private placement regime, which in effect is a subset of AIFMD, which gives us a faster, cheaper, more efficient access point than other European jurisdictions. We have the guarantees in place with the EU member states. Our private placements into the UK is guaranteed. So in a pre-Brexit world, we acted as a bridge to the UK, Europe, and the rest of the world. And it's absolutely no change for us. But there's one statistic that you've probably heard me say on a number of occasions. The EU's own statistics are that only 3% of managers market into more than 3 European jurisdictions. So one has to question whether a full European-wide passport is the most cost-effective and best way to go. As it happens, Jersey's in the first round of third countries to get the passport, if it's ever granted. But if you look at the KPMG2 pre-AIFMD report, it very clearly states that the managers and investors want private placement to stay. And the two have coexisted right the way through the AIFMD, and there is no reason for that to change.
Right, thank you. Unless anyone want to comment on accessing European markets, so if not, I want to quickly change subjects, and then we've got these massive number of questions coming in. We'll try and tackle a bunch of those before we finish. Can I quickly turn, particularly for those of us following this, and there's quite a lot of the audience, although there's quite a lot of people in the US, there's quite a lot of people outside the US too. Can you outline, perhaps we can go first to Miles and then to Stephen, what's happening in the private funds market? We've had a change in administration. Miles, you said on the prep call the other day, you think there could be potentially significant changes from the SEC with a new person in charge. So where do you see the US going?
Yeah, I mean, we're going into an increasingly regulatory environment. I mean, if we see the philosophy of the Biden administration, it has been really demonizing not only capitalism, but those who run the larger hedge funds. I mean, it's okay because for them to take large political contributions from us, but they're certainly not giving us anything in return. But a couple of things to concentrate on. First of all, Biden nominated Gary Gensler to be the SEC chair, and he's come out with some pretty progressive and intrusive pronouncements about public companies disclosing how climate change affects their business. He wants new rules for broker-dealers and advisors about how they meet certain ESG criteria, and also a lot of very robust rulemaking as far as increasing diversity in corporate governance, which absolutely is something that we should all be, promoting. But if it's promoted in a way that becomes, again, onerous on us, that could lead to increased regulations in other areas. But the most troubling of all is Biden's pronouncements on tax. We talked about tax efficiency before. He wants to use us as a way of tax redistribution. And the way that he wants to do it is not only by increasing capital gains, but also looking at becoming very much burdensome taxes, not only on funds, on managers and investors. And he believes in this way, this is a way that he can redistribute wealth, is by looking at people who have been entrepreneurial and profitable in American capitalism and punishing them for their success. And so I think that both on the tax and the regulatory areas, we're going to see increasingly more regulation, but I don't think it's regulation that's going to do anything to help protect investors' interests. I think it's just going to be punitive in nature.
Wow. Eileen and Stephen, I got to ask you whether you agree or disagree with that. Can you give a quick response to what Miles just said?
I'm happy to jump in. I think as an initial matter, there are signs that there will be a greater focus on enforcement. I think the expectation that rules can be bent or ignored is something that we're already seeing as a firm. People are reassessing. As a lawyer, as somebody who tries to operate within and create structures that are intended to operate within set rules, the prospect of increased enforcement is not something that by itself troubles me too much. But I do think there's going to be a little bit more focus on enforcing the rules that are in place. In terms of new rules and the prospects of material changes in the private funds space, right now I think the jury is still out. I don't know that we're going to be doing anything significantly different next year or in 2 years than we are now. I would concede that the prospect of changes in the tax code are real. I don't know that there's necessarily a whole lot of leeway in Washington to do very significant changes, but I may be wrong there. I may be underestimating the prospects of really significant regulatory reforms. So I'll wait on that and with interest to see what happens. But right now, I think in terms of the regulatory environment, I'm fairly optimistic that we'll have a period of some stability and we won't be seeing massive changes.
Okay. Eileen,
I do think there are some. Sorry, one thing I would note, and you know, I'm saying this from I think a different political starting point than Miles is. I think that there are some deregulatory efforts, some efforts to reduce administrative burdens associated with regulations that will fall by the wayside. I think there are clearly proposed rules that are not going to be moving forward. So there will be some, on a comparative basis, increases in regulation relative to what we might have seen otherwise. But that isn't to say that we're going to see a change relative to where we were. It will simply be some of the deregulatory activities will not be moving forward.
Okay. Eileen, do you want to respond as well?
Yeah, so I tend to agree with Miles at a very sort of macro political level. I think he and I probably agree on a lot of politics. But I also tend to agree with Stephen that enforcement will increase, but it doesn't mean that the SEC is going to find anything. You know, they're not going to unearth some sort of malfeasance or anything like that. Most managers are highly compliant with the law. I think the result will be instead increased cost to be an entrepreneur in this space, and perhaps some interesting findings coming out of OC or whatever they call themselves now, that might change things sort of retrospectively, where, as we've seen in the past, they put out these risk alerts or guidance, or there are enforcement actions that now impose new rules that no one thought was the case and no one really considered to be industry standard. So I think there'll be some hard decisions coming out to be compliant again, sort of retrospectively on things like that. But I also agree with Stephen. For example, for a while, they've been talking about the 13F filing going away. I think that certainly will fall by the wayside now. We will continue to have that reporting obligation in the US, and there'll be still a push for more and more transparency.
Okay, thank you. We've got about, in fact, 9 minutes left. I'm going to try and pick questions. I've been glimpsing the questions as they've been coming along. Some questions are focused on specifically what does it mean for this jurisdiction or that jurisdiction. I'm going to try and avoid those if I can, although there is one interesting one I might come to, and try and keep them on more a generic level. So the very last one is kind of already been touched upon, but perhaps I will take it. I saw another ESG question as well. The question is, don't answer this yet, but I think there's another one I'd like to throw in at the same time, is if ESG does influence domiciliation selection, how might that manifest itself? And then there is another one is, how might ESG change fund industry practices? There is no evidence of it doing so today. I'm guessing that for that second question may have come from someone in the US. I think it is beginning to, I'm going to answer that question first, if I may. I think it is beginning to change industry practices. It's certainly in terms of fund board composition, that's beginning to happen. There's much more of an interest in having gender diversity. Goldman Sachs Asset Management just a year ago put out something, they will not invest in any corporate, any company unless there's a woman on the board, full stop, right across the board. And I think other firms, BlackRock, many other firms have been making comments in the same direction. And if you look at what questionnaires investors are putting out to managers about how the governance of the manager's business shows that there is much greater interest in that. There is much greater interest, at least on this side of the pond, in questions about ecology, green movements. There's a few service providers now that have on the bottom of their emails, they're a carbon neutral organization that may not have yet come to the US, but I think it is happening. So I think to dispute the question, sorry to have an argument with an anonymous questionnaire, but I think that it is beginning to have an impact. But over to you guys, what do you think it has had an impact? Do you think it will have, not just on strategies, but in terms of the way you guys run your business, even lawyers or managers? Do you think it will have an impact upon industry practices, or is this just another strategy? Anyone want to pick that up?
I think it's definitely at the forefront more in Asia and in Europe than in the US. You know, we've long said we have a very deep pool of talent here in Jersey, and we have been all over the governance for a number of years. I think it is coming to the fore in an accelerating way. And I think it is probably being driven by intergenerational wealth passing from one generation to the next, and the younger generation wanting the E and the S. And as they are the people who will be making the investments, that is what the driver is. I was just at a very good family office conference in New York. Well, it must have been the year before last, I think we were anywhere last year, where that was the key point of the conference. And we as a jurisdiction are seeing it, and we as a jurisdiction are reacting to it. I mean, our government have their plans, our industry have their plans, but this is the way the world is going. But it is absolutely the case that Asia is ahead of Europe, Europe is ahead of the US.
Okay, that's interesting. Quickly, I've got some other, does anybody else want to respond to that before I go into another area?
I would say that I'm probably not on the cutting edge of this, but I am seeing an increasing number of clients who have been adopting ESG policies, and at the very least are being more thoughtful about the activities that they and their portfolio companies are engaged in. So I don't want to dismiss that as greenwashing, but I do think that people are either actively changing their programs, or at the very least thinking about what they're doing, and that's something that's being driven both by the clients, the managers, but also in response to actual or perceived investor demands. And that's clearly going to continue.
I'm going to, we've only got 5 minutes left. I'm going to try and take two slightly different, if not somewhat different questions together and just throw them at you and see whether you can pick these up together. One is, once it's come in, does the because I think in some way they're more related than perhaps they first might seem. Does the panel see KYC/AML requirements increasing in the US, moving towards the levels seen in other non-jurisdictions? And the second one, which we haven't discussed at all in the last hour, is if the EU decides to blacklist Cayman, there's talk of that potentially happening again, would it make any difference to its business in the US or with the US? Eileen, do you want to have a go, one or both of those?
Sure. So I think AML KYC will be a continuing conversation in the US. There have been some recent updates to our AML law, although so far it seems to not have a particular impact on private funds. But I wouldn't be surprised if in the next 5 years, we're going to have a supplement to our subscription agreements that are equally as cumbersome as those in Cayman. I think, set aside the US fund managers, fund administrators continue, even in the US, to be very diligent and very good at this. So they're certainly doing the hard work. It's just a matter of whether the law then technically extends to the managers as well. But I wouldn't be surprised if that becomes the case.
Yeah, and I agree with you, because ever since the Patriot Act, AML has been strengthening. I mean, it's surprising that technically investment advisors are not required to have AML programs, which are shocking to me. But because you work in a number of jurisdictions, KYC and AML is vitally important, especially in the US, where it's almost a strict liability situation where AML carries substantial penalties, in fact, even imprisonment. So I think most advisors to private funds have pretty robust AML compliance programs in place already.
And of course, it's the reputational risk, right? It's the headline risk that they worry about probably even more than anything else.
Do you see, before we leave this area and leave all the other areas, do you see with the new administration in Washington any changes in what is accessed in offshore jurisdictions, or how that happens? Or do you think that the Biden administration's got enough on its plate, it's not going to be touching that? I notice he is from Delaware, which has been raised today. I don't think that makes any difference at all. Quickly, got any comments on that? Nothing's going to change. You think it'll stay as it is? So at least if Cayman does get problem from the EU, life will be okay with the US.
Yeah, I don't see that impacting the relationship at all.
Okay. Well, we're almost out of time. I think probably I will come, rather than getting into a whole new area. We've got a lot of questions I see still on ESG. We'll try maybe get to those separately. Those of you, thank you, who've given us your names, who've asked questions. We'll try and get back to you if we can with answers in the foreseeable future. And we will put a recording of this webcast up on one of our sites in the near future as well. So you can also come back and look at that. I'd like to thank you all for joining us this evening, UK time. And thanks very much to our panel for all their contributions. I went incredibly well. Thank you for that. And thanks also to Jersey Finance for sponsoring this event. As I said at the beginning, we will be completing the research study I referred to and sending that out in the next few weeks. And then if anyone wants to be interviewed for the study we're going to be doing on fund director selection, if they're in the manager or advisor category, then please do let me know. And our researchers will come to you during the month of March if you're in the US, or in the month of April if you're in the